world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hi, I'm Will Beeson. Welcome to Rebank. Today we're going to try something different. We recently sent out an email to our newsletter subscribers called "The Banking as a Service Value Chain is Broken." Today we're going to walk through that essay. We're going to read it in full. For those who prefer audio to email, it's that simple. If you enjoy this sort of analysis, feel free to subscribe to receive it by email at rebank.cc. Without further ado, let's jump in. All right, here we go. I sent out an article this morning, something that I've been thinking a lot about over the past few weeks. It's about the value chain in banking as a service. So this concept of banking as a service, the backbone of a lot of consumer fintech, fintech for businesses, and also actually a lot of embedded finance. I have some thoughts on the value chain, and frankly, I expect it to evolve. Again, the piece is called "The BaaS Value Chain, Banking as a Service Value Chain is Broken." Banking as a service has been the subject of much excitement in fintech over the past few years, together with the related but more general concept of embedded finance. The proliferation of APIs capable of connecting disparate data and services means digital product offerings can quickly and easily be composed from components sourced from many different places. First, a little background. Partnerships between companies offering complementary services have always existed, but APIs allow for greater scale, more efficient delivery, and self-service. Traditionally, car dealers may have referred customers to partner lenders or leveraged centralized auto finance business units to help customers buy their cars. Today, a developer can build a car buying app and embed a lending partner into the checkout flow via API, with the parties tailoring and underwriting loans based purely on communication between software applications. In fact, fintech lending companies built today can reasonably decide to only offer an API without any front end whatsoever. The value chain is optimized, we're told, across origination, distribution, and any intermediate or ancillary services, such that companies can specialize in just one. Banking as a service, which we'll call BaaS throughout the reading, extends this API-based finance concept to more banking services, including checking, savings, debit cards, credit cards, lending, and more. Modern BaaS platforms are purpose-built to deliver banking services to non-banks via API. Neobanks like Chime, brokerage apps like Robinhood, and hundreds of other consumer and business fintechs have built their offerings atop BaaS providers, allowing the delivery of regulated products without the fintechs themselves becoming licensed or holding capital. This model is coming under increased regulatory scrutiny from banking regulators and could eventually be impacted by new rules. These developments are not the focus of this piece, but readers should follow Jason Mikula, I hope I'm pronouncing that correctly, Jason Mikula's work for more on this evolving topic. Instead, today I'd like to take a closer look at the BaaS neobank value chain, which I argue is not currently in equilibrium and predict will evolve. The value chain is complex, and the landscape of companies providing services is very crowded. There's some images in the article itself, which we'll link to. There are four main participants in this value chain. They offer distribution, orchestration, product creation, and connectivity/optimization, respectively. Consumer-facing fintechs and tech companies are the last mile. They're the customers. Sorry. Let me bullet out the four main participants in this value chain so then we can break it down. The first are consumer-facing fintechs or tech companies. They're the quote-unquote last mile. Their customers are consumers or businesses. The second participant are BaaS platforms themselves, software companies offering banking products and core banking via API. The third set of participants are banks or regulated financial companies, quote unquote, product manufacturers that hold licenses and capital. They're the ultimate deposit holders in the case of checking or savings accounts, and occasionally banks offer the APIs or software layer as well. And lastly, ancillary service providers, things like KYC, AML, fraud prevention, card services, payment services, data aggregators, etc. And these four groups of participants broadly earn the following revenues. The first, the consumer-facing fintechs and tech companies, the last mile, earn interchange, subscription fees, cross-sales, and interest share. BaaS platforms earn license fees, account fees, transaction processing fees, and service fees. Banks and regulated FS companies earn interchange. They earn interest, specifically net interest that they generate through lending out their deposits, service fees and program fees. And ancillary service providers earn pay-per-use fees, license fees, and transaction and or processing fees. There's a lot there. In the current model, value capture is disproportionately skewed toward BaaS platforms and ancillary service providers at the expense of the fintech tech company last mile. Fintechs rush to offer free or low-cost services to consumers and business customers, limiting their revenue potential. While B2B API providers, the quote-unquote picks and shovels of embedded finance, face no such pricing constraints. As an indication of the value accrual to these components of the value chain, observe fundraising activity, which is charted below. Again, refer to the original piece to view the table. And ask yourself what value capture expectations are baked into these raises and valuations. The table outlines, 20 or so of the leading, what I call ancillary service providers, KYC, AML, fraud, data aggregation providers, Plaid, Socure, Trulio, Imex, Tink, FeedZai, TrueLayer, top the list with just massive amounts of money being raised. So ask yourself again, what value capture expectations are baked into these races and these valuations? So then looking at each of the components one by one, or I guess the three of the components, starting with BaaS providers. Call it the infrastructure, the value chain post the consumer tech or fintech last mile. So for BaaS providers, here I refer to non-bank software companies that are offering the connectivity between sponsor banks and fintechs, generally including core banking and payment services. Some legacy players come to this business by extending traditional cores to support the sponsor bank model. Other providers started in payments and extended into BaaS. And some startups launched with the express purpose of building API platforms to run atop banks. An entirely different set of BaaS providers are actually banks themselves, a subset. Banks that offer the API infrastructure themselves to fintech partners. Examples include Green Dot, Cross River, and BBVA. In short, there are various approaches to this layer of the value chain. It is a fundamental component of the stack. It's currently expensive and does not get sufficiently cheaper with scale from the standpoint of last mile fintechs that are paying for it. The natural value chain optimization would be for BaaS and regulated capitalized banks to merge and offer a developer-focused self-service approach to implementation. Column is following this path and will be an interesting case study, though they're reportedly facing regulatory challenges. We link to an article on that subject in the piece. Rumored headwinds notwithstanding, Column is positioning as a Stripe of banking. There's some imagery that you can check out in the post. But extrapolating beyond Column itself, a robust, truly tech-first, developer-focused BaaS platform with a banking license is the natural evolution of this model. There are currently a very small number of banks and fintechs that could credibly pursue this path if they fully committed to it. Ancillary service providers. Some offerings are differentiated Some ancillary service provider offerings are differentiated and high value for a specific use case. Examples include Sardine for real-time fraud prevention and fiat crypto on-ramping, and Pinwheel for direct deposit switching, important functionality for consumer neobanks. As valuable as these specific services are, the math doesn't add up in the aggregate for many last-mile fintech companies. If you're a neobank customer of a few different ancillary service providers, your cost base to service an account quickly becomes significant, especially if you seek to offer a range of products to customers. Giving your product away for free is unsustainable given this cost structure. Counterintuitively, free banking was easier to justify as a business model prior to the proliferation of so many ancillary services. The counter to this point is that perhaps it's the economics of consumer fintech that are the problem, not the cost of the infrastructure. Now, there's certainly merit in that argument too. Lastly, banks. Banks are ultimately the most fundamental piece of the value chain. They generally position their embedded finance, aka fintech partnerships businesses, to succeed when last mile fintech partners achieve significant scale, which has not necessarily materialized. Data confirms the balance sheet benefits of providing sponsor banking services, though that's only part of the equation. A recent analysis by S&P, which we linked to in the article, shows that among banks with assets between $1 to $3 billion, fintech sponsor banks grew deposits by 15% annually over the past 3 years, compared to non-sponsor bank peers at 3%. Now, I expect some self-selection in these figures, as sponsor banks generally get into the business with the goal of growing deposits. It's unknown whether all banks in the peer group were targeting such deposit growth. Deposit growth from sponsor banking comes with costs. Banks must invest, potentially heavily, in operations, technology, compliance, and headcount to support the partnerships business. The expected increased regulatory scrutiny on sponsor banks would only further increase the cost of providing these services. Taken together, I would be surprised if many fintech sponsor banks were providing these services profitably today. It'll be interesting to see what impact a rising rate environment combined with the slowdown in consumer fintech usage has on fintech sponsor bank economics. I'm as bullish on embedded finance as anyone else, with payments and lending the low-hanging fruit. But it's clear that the value chain must evolve if richer product configurations are to be sustainable. Thank you very much for listening today. To access the full article, check out rebank.cc. And if you want to receive this in your inbox in the future, sign up to the newsletter. Thanks, and speak soon.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.